So here's this week's portfolio. It looks like we have about 78% in the US, 22% are foreign companies, and in our Morningstar style box here we see that all of them are large cap stocks with 42% value, 48% core. That means it's got characteristics of both value and growth. Then about 7% are growth, so we're really leaning a lot towards large cap value here. Going on down to the sectors, we see that we're still a lot underweight on cyclical companies and more overweight in defensive companies. This is the S&P 500's allocation, and here's ours. So we have about 13% in cyclical, whereas the S&P 500 was about 33% in cyclical. And this means we're a lot underweight on consumer cyclical as well as financial services. Our sensitive sectors are somewhat in line with that of the S&P 500, although we're a lot more overweight on energy and communication services and underweight on industrials. But in the defensive side is where we've really got our larger stance here. We have consumer defensive is a little heavier, and healthcare as well. So all in all, our largest sectors would be energy at 19%, technology at 20%, and healthcare. And this is somewhat in line with all of our previous recent portfolios as well. And those three combined equals about 58% of our portfolio. So let's go down to some statistics here. We see that our PE ratio on the prospective earnings is about 14. And that's about 88% of what the S&P 500 is. In a similar fashion, the price to book ratio is 2.36, which is about 83% of the S&P 500. So it looks like we're buying the earnings and the net assets of these companies for cheaper than we would be if we were buying the S&P 500. Return on assets, return on equity is a little bit lower than that of the S&P 500 as well. And over here some other characteristics of value companies, which is what we're largely invested in. Our earnings per share growth rate over the next 5 years is about 7.55%, which is 70% of the S&P 500. So if we were in more in line with growth companies, we might be a little higher than the S&P 500 as far as the earnings per share growth. But actually, since we're more weighted towards value companies, we don't have as much growth factored in. Also, our dividend yield is about 89% higher than the S&P 500. So our dividend yield is about almost double that of the S&P 500. And since we're more weighted towards large cap companies, we see that the size of our companies is about 37% higher than that of the S&P 500. So let's look at our top 5 holdings. We see we've got here Total, General Mills, Sanofi, AT&T, and Intel Corp. And we see these make up a lot of the allocation where we talked about before. We've got the oil and gas here, some consumer defensive, healthcare, and some technology. And so all these top 5 holdings make up about 39% of our portfolio, and we've got 20 stocks in total.